Financial Times. This was yesterday. I didn't get to it yesterday. The New York Fed, not one guy like Neil Kashkari in Minnesota, the head of the Minnesota Fed, who was saying we need to break up the big banks a couple of days ago. And this is the entire New York Fed is warning asset managers. In other words, companies, like they advertise E-Trade or Fidelity or whatever, these companies that, or maybe it's the fund managers, I guess, that they're vulnerable to runs. And this is from Robin Wigglesworth writing in the Financial Times. The combination of deteriorating trading conditions, especially in corporate bonds, combined with the swelling of the U.S. mutual fund industry is the setup of the problem, right? In other words, everybody's putting money into these mutual funds. And here's the thing. It's a big hit. If there's a market downturn and all across the United States, people start pulling their money out of those mutual funds. Hey, I want to get out of the stock market and I've got it in a fund rather than in a particular stock. Big hits can cause withdrawals that overwhelm the fund's cash reserves and force asset managers to sell hard-to-trade securities. That may, in turn, require them to sell those securities at fire sale prices, hurting the fund's performance further. So some of us sell our mutual funds. That hurts the mutual fund. Its value goes down. Others are looking at going, oh, my mutual fund is crashing. I'm going to sell. And that's how bank runs happen. In fact, here's the paragraph. That may in turn require them to sell at fire sale prices, hurting the fund's performance further. This means that investors have an incentive to withdraw their money early, triggering a similar dynamic to a bank run. So now, not just big banks could come crashing down, but, big mutual funds could come crashing down. And that's pretty damn scary because I don't think there's FDIC insurance for mutual funds. Another one, this was by Kevin Short, the editor over at the Huffington Post business section. Everyone in America is even more broke than you think. And this is one of the reasons why these mutual fund things are so vulnerable, is, in my opinion, is because, people have, the average American has, maybe $5,000-$6,000 in savings. It's not very much. And that's by and large in the white community. The African American community is a fraction of that. But here's the numbers just nationwide, regardless of ethnicity or race or anything else. And this is just astonishing. If you make more than $10,000 a year, you earn more than 24.2% of all Americans, 37 million people. If you make $10,000 a year, about a quarter of America makes less than $10,000 a year. And this is, obviously working Americans. If you make more than $15,000, you earn more than 32% of Americans. If you make more than $30,000, you make more than 53% of Americans. Now, this goes back to the median income in the United States is depending. I've seen numbers that vary from $22,000 to $27,000, but it's in that neighborhood. If you make more than $50,000, you earn more than 73% of Americans. And if you make $100,000, you may earn more than 92% of Americans. The top 1%, you have to make more than $250,000. And at the very top, there are 894 people who cumulatively last year made $37,009,979,568. And they represent... They make more than the bottom 99.99989%. So that's the bottom point, or that's the top 0.0001% functionally. So that's pretty startling. To watch more clips from our programs, hit the Watch More Videos button over here. And please be sure to hit the handy dandy subscribe button so you'll always be up to date. Tag, you're it.